The currency in your pocket has just been declared worthless. You don't fully believe it at first. It sounds like something temporary, a rumor, maybe an overreaction. So you do what anyone would do. You go to the market. Same place, same vendors, same routine. But something is off. There's noise, more than usual. People speaking faster, louder. Some arguing, some just standing there, holding stacks of bills like they're trying to figure out what to do with them. You walk up to a stall. Potatoes. Basic, essential. You hand over your cash. The vendor doesn't even look at it. He just shakes his head. You try again. Maybe he didn't understand. You offer more this time. Still nothing. No negotiation, no hesitation. Not money, he says. Now you move to another stall. Same result. Then another. Same again. Everywhere you go, it's the same pattern. The bills in your hand. Yesterday, they worked everywhere. Today, they work nowhere. Pause for a second. Because this is the moment everything changes. It's not that goods disappeared. The food is right there. The problem is the bridge between you and that food, money, has collapsed. And without that bridge, you're left with a question most people have never had to answer. If you can't use currency, what do you actually have to trade? Because in that moment, it's not about how much money you have. It's about whether you have anything anyone else actually wants.
When money breaks, the economy doesn't disappear. It strips down to something more basic. That's the part most people miss. There's this instinct to think that if currency fails, everything freezes. Trade stops, markets collapse, life stalls. But that's not what actually happens. What happens is more raw than that. The system doesn't die, it reverts. Because money was never the economy itself. It was just a tool, a shortcut, a layer of abstraction that made exchange smoother, faster, less dependent on coincidence. You didn't need to find someone who wanted exactly what you had. You just needed money, and money would bridge that gap. Remove that bridge, and the gap doesn't disappear. It just becomes visible again. People still need to eat. They still need things fixed. They still need services, energy, materials, everything that made the economy function in the first place. Demand doesn't go away. Only the convenience does. And without that convenience, people fall back to the only system that doesn't require trust in currency: direct exchange. At first, it's messy, awkward, inefficient. You have to negotiate everything. You have to find someone who not only has what you need, but also wants what you have. Sometimes that match doesn't exist. Sometimes it takes time. Sometimes the trade feels uneven. But it works. And more importantly, it's real. Because in that environment, value stops being abstract. It's no longer tied to a title, a contract, or a salary number on a screen. It's tied to usefulness, immediate, tangible usefulness. You don't get rewarded for what you are supposed to know. You get rewarded for what you can actually provide, right now, to someone who needs it. And that changes the question completely. It's no longer, how much do you earn? It becomes, what can you offer directly? Pause for a second and sit with that. Because most people have never had to answer it in a serious way. In a functioning system, you can go years without thinking about the raw utility behind your income. But in a reverted system, that layer is gone. No buffer, no abstraction, just value for value. And over time, something interesting begins to happen. Out of all that chaos, patterns start to form. Certain goods become easier to trade. Certain items get accepted more often. People begin to recognize what holds consistent value across different exchanges. And without anyone officially designing it, a new form of money begins to emerge. Not because someone declared it, but because people needed something that worked.
If you want to see how money re-emerges from chaos, one of the clearest examples comes right after post-World War II Europe. At that point, much of Europe was physically intact enough to function, but financially broken. Official currencies still existed, technically. Governments hadn't disappeared. But the trust behind those currencies was gone. Prices were unstable. Supply chains were fractured, and in many places, cash simply didn't work the way it used to. So, people adapted. Not through policy, not through some coordinated reform, through necessity. In prisoner of war camps and civilian markets alike, a strange thing began to happen. Cigarettes, ordinary, everyday items, started functioning as money. Not because they were declared as such, but because they solved a problem. Think about what makes something useful as money. It needs to be widely accepted, easy to divide, relatively uniform, portable, hard to fake, and ideally, it should have its own intrinsic demand, something people want even if they don't trade it. Cigarettes checked almost every box. They were standardized. One cigarette was roughly the same as another. They were divisible. You could trade one or a pack, or even break it down further. They were portable and easy to carry. And most importantly, they were in constant demand. Even non-smokers would accept them because they knew someone else would. Pause for a second. That's the key moment where something stops being a product and starts becoming money. Not when it has value to you, but when you know it has value to everyone else. And once that shift happens, trade becomes easier again. Instead of needing a direct match, I have bread, you have tools, you introduce an intermediary. I'll take cigarettes for the bread, then use those cigarettes to get what I actually need. The system rebuilds itself, one layer at a time. Prices begin to form, not in official units, but in cigarettes. A loaf of bread costs a certain number. A repair service costs another. Over time, people begin to agree, implicitly, on these values. Not perfectly, not permanently, but enough to make exchange functional again. And here's what's fascinating. This wasn't imposed. No central authority declared cigarettes as legal tender. No institution enforced their use. It emerged organically because it worked better than anything else available. That's how money actually forms. Not from decree, from utility. Now think about what that implies. If a system collapses far enough, people don't wait for a new official currency to be issued. They don't pause economic activity until policy catches up. They improvise. They experiment. They converge on whatever solves the problem of exchange most efficiently. And it's rarely something abstract. It's something simple, familiar, useful. Cigarettes weren't chosen because they were ideal in theory. They were chosen because they were available, trusted, and easy to use in that specific environment. But there's another layer here. Even this system wasn't perfect. Supply fluctuations affected value. If cigarette shipments increased, their purchasing power dropped. If supply tightened, their value rose. Counterfeiting became an issue in some areas. Quality differences mattered. In other words, all the same monetary dynamics reappeared, just in a simpler form. Because once something becomes money, it inherits all the pressures that money carries. Still, for a period of time, it worked. Trade resumed, markets functioned, people were able to coordinate again, not because the official system was restored, but because an unofficial one emerged in its place. And this is the deeper lesson. Money isn't as fixed as people think. It's not tied permanently to paper or coins or digital entries. It's a social agreement, a shared belief that something can be exchanged for something else. Break that belief, and the system collapses. But remove the official structure entirely, and people will build a new one, from whatever they have left.
Now, take that idea, money emerging from necessity, and scale it beyond small groups, beyond camps, into entire communities. Because this isn't just something that happened after a war. We've seen modern versions of it in real economies with millions of people involved. Look at what happened in Argentina during its economic crisis in the early 2000s. The financial system didn't just weaken, it seized up. Banks restricted withdrawals, currency confidence collapsed, unemployment surged, and suddenly a large part of the population found themselves cut off from the formal economy. Not completely, but enough to feel it. Cash was scarce, jobs disappeared, and even when people had money on paper, access to it became uncertain. So people did what they always do in that situation. They adapted. Across the country, something called barter clubs began to form. At first, they were small, local. A few dozen people meeting in community spaces, schools, parks, empty lots. Each person brought something they could offer. Homemade food, clothing, repair services, tools, even lessons or childcare. No official currency, just exchange. At the beginning, it looked chaotic. People negotiating trade after trade, trying to find matches. But over time, structure emerged. Some groups introduced their own local tokens, not backed by the government, but accepted within the network to make trading easier. Others relied purely on direct barter. And then it spread. What started as small gatherings turned into massive networks. In some cases, thousands of people participated. Entire parallel economies formed, running alongside the official one, but operating on completely different rules. Pause for a second, because this is the part most people underestimate. This wasn't theoretical. It wasn't experimental. It was survival. People weren't joining barter networks because they preferred them. They joined because the traditional system wasn't working for them anymore. It wasn't providing income, stability, or reliable access to goods. So they built something that did. And what made these systems function wasn't technology or enforcement. It was proximity and trust. You were trading with people you could see, people in your neighborhood, people who had a reputation to maintain. That reduced friction, reduced uncertainty, made exchange possible even without a formal legal framework. If someone consistently provided value, people would trade with them again. If someone cheated, word spread quickly. They were excluded. Simple. Now compare that to a large, anonymous system. Trust is harder to maintain at scale. Enforcement becomes more complex. Verification becomes necessary. And that's where things start to strain. But at the local level, these networks were surprisingly resilient. They didn't replace the national economy entirely, but they filled the gaps. They allowed people to access food, services, and basic necessities when traditional channels failed. And they revealed something important. Money isn't just a currency issued by a government. It's a coordination tool. And when that tool fails, people don't stop coordinating. They find another way. Now, not everything was smooth. As these barter networks grew, problems started to appear. Some local tokens were overissued, leading to inflation within the system. Quality control became harder. Trust, which worked well in small groups, began to weaken as networks expanded. But even with those flaws, the core function remained. Exchange continued, people survived. And this is the key takeaway. When formal systems break, the economy doesn't vanish. It fragments into smaller, localized systems built on trust, utility, and immediate need. Not efficient, not scalable in the way modern finance is, but functional. And in a crisis, function matters more than efficiency. Which leads to a natural limit. Because while these systems work well in small groups, something starts to break when they grow too large.
Here's the uncomfortable truth about barter systems and local exchange networks. They work, but only up to a point. At the community level, everything holds together because of one fragile ingredient: trust. You know who you're trading with. You've seen them before. Maybe you live in the same area. Reputation travels fast, and consequences are immediate. If someone cheats, they're excluded. If someone consistently delivers value, they're welcomed back. That's enough to keep the system running. But as these networks grow, something changes. Distance increases. Anonymity creeps in. You start trading with people you don't know, people who aren't part of your immediate circle. And the moment that happens, trust stops being automatic. It has to be replaced, usually with something else. Standardization, verification, sometimes even enforcement. And this is where the cracks begin to show. Take locally issued tokens, for example. They start as a useful shortcut, something to make exchange easier than pure barter. But as circulation expands, control weakens. More tokens get created, sometimes too many. And once that happens, the system starts experiencing its own version of inflation, not because of a central bank, but because supply is no longer trusted. Then there's counterfeiting. In a small group, it's hard to fake something without being noticed, but at scale, that becomes easier. Fake tokens, low-quality goods, broken promises, these issues multiply as the network grows beyond personal relationships. And slowly, friction returns. Trades become harder. People become more cautious. The efficiency that made the system attractive starts to degrade. Pause for a second, because this is the pattern repeating itself. Small, trust-based systems work well, but don't scale easily. Large systems scale, but require structure, rules, and eventually some form of centralized control to maintain trust. And that's the cycle. Barter, local tokens, larger networks, breakdown of trust, demand for a more stable, widely accepted form of money, which is exactly how formal currencies emerge in the first place. So these barter economies aren't permanent replacements. They're transitional. They exist in the gap between system failure and system rebuilding. And that leads to a very practical question. If you were dropped into that gap, even temporarily, what would you actually have that holds value on day one?
So, what do you actually do with all of this? Not prepare for collapse in some extreme all-or-nothing way. That's not realistic, and it's not necessary. This is about understanding what holds value when money doesn't, and building a small layer around that. Start with something simple: consumables. Items people need regularly, that run out, and that don't depend on a functioning financial system to be useful. Basic hygiene products: soap, toothpaste, sanitary items. In normal times, they're cheap and forgettable. In a disrupted system, they become consistent trade goods, not because they're rare, but because they're always needed. Then think about tools. Not expensive, specialized equipment, but simple, durable tools that solve everyday problems. Repair kits, basic hand tools, things that allow you or someone else to fix something instead of replacing it. In a constrained environment, repair becomes more valuable than consumption. Now layer in skills. This is the part people overlook the most. A physical item can be traded once. A skill can be traded repeatedly. Basic repair, food preparation, maintenance, even something as simple as knowing how to grow a small amount of food. These are forms of value that don't expire, don't get used up, and don't depend on external systems to function. And here's the key. You don't need to go deep. You just need to be useful. Because in a barter environment, value isn't measured by prestige or complexity. It's measured by whether you can solve a problem someone else has right now. So the protocol is simple. A few consumables, a few tools, at least one practical skill. Not to replace money, but to create a buffer when money stops working the way you expect. Because at the end of the day, the question isn't theoretical. If your currency fails, what do you actually have that someone else will take?